Want to invest in a business model that is both ubiquitous and necessary? Looking to collect a safe, growing dividend that beats the market? Like the idea of getting a good deal on a quality stock? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing valuable and necessary utility services to millions of people. A utility business is about as sure a thing as you could possibly imagine. Try living without electricity for a second. Actually, don't do that because the computer you're watching this video on might be plugged in. The truth is, we can't do it. Our society, as we know it, would collapse without electricity. This basic need is what powers growing profits and growing dividends for utility businesses like the one I'm about to tell you about. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Sempra Energy, which appear to be trading at a significant discount today. Sempra Energy, stock ticker SRE, is a natural gas and electric utility holding company that serves 36 million customers across parts of Southern California, Texas, and Mexico. Founded in 1998 through a merger, but with a corporate history dating back to the 1800s, Sempra Energy is now a $41 billion by market cap utility giant that employs almost 20,000 people. The company operates across 5 segments: SDG&E 47% of fiscal year 2020 revenue, SoCal Gas 41%, Sempra Mexico 10%, Sempra LNG 2%, and Sempra Texas Utilities 0%. The bulk of the company's operations involve providing natural gas and electricity to residents throughout Southern California. A utility such as this has a very straightforward investment thesis. Our modern day society cannot function without the power that utility companies deliver. They have captive customers who require their services. Life as we know it would cease to exist without the likes of Sempra Energy, which makes their business model both ubiquitous and necessary in their markets. This ubiquity and necessity is what drives reliable rising profits and reliable rising dividends. Sempra Energy has already increased its dividend for 18 consecutive years. The 10-year dividend growth rate is 10.2%, which is actually rather outstanding for a utility business. Most utility businesses I've seen are growing their dividends in a mid-single digit range. That said, there has been a slowing of late. The most recent dividend increase came in at under 6%. Nonetheless, the stock yields 3.3%, which gives you a market-beating yield to go along with that dividend growth. This yield, by the way, is 30 basis points higher than the stock's own 5-year average yield. And the dividend looks safe with a moderate payout ratio of 56.4% based on midpoint guidance for this year's adjusted earnings per share. I like to see dividend growth stocks in what I call the sweet spot. That's a yield of between 2.5 and 3.5% paired with a high single digit or better dividend growth rate. This stock is right there. Looking at business growth, Sempra Energy increases revenue from $10.036 billion in fiscal year 2011 to $11.370 billion in fiscal year 2020. That's a compound annual growth rate of 1.4%. Not particularly inspiring, but it's also not terribly surprising for a large utility business. Meanwhile, earnings per share grew from $5.51 to $8.03 adjusted over this time period, which is a compound annual growth rate of 4.27%. That kind of EPS growth is right about what I'd expect from the likes of Sempra Energy, if a bit light. Notably, I did use adjusted earnings per share for the most recent fiscal year. The business recognized a large gain on its South American business businesses in 2020 that isn't indicative of ongoing earnings power. If we were to use GAAP earnings per share for fiscal year 2020, the 10-year earnings per share compound annual growth rate would improve significantly, but I don't think that'd be accurate. Looking forward, CFRA forecasts that Sempra Energy will compound its earnings per share at an annual rate of 5% over the next 3 years. I see this as a reasonable forecast. This is basically right in line with what kind of bottom line growth the business has produced over the last decade. And I don't see anything that would meaningfully change that dynamic. CFRA believes that Sempra Energy will benefit from an increase in both customers and rates. There's also the company's Cameron LNG export facility. It should reach full capacity by the end of this year, and this could bolster the company's near-term prospects. On the other hand, the exit of the South American businesses further concentrates them on their local markets, and this will weigh on near-term results. CFRA's growth forecast would permit Sempra Energy to increase its dividend at a similar rate or better. The latter could actually be more likely. Sempra Energy has been slowly expanding its payout ratio over the last decade, which is why you see the long-term dividend growth rate exceeding the 10-year earnings per share compound annual growth rate. They can continue to do this and may very well continue to do it, as many utilities operate with a much higher payout ratio. Moving over to the balance sheet, the company has a good financial position. The long-term debt to equity ratio is 0.93, while the interest coverage ratio is over 2. These numbers are not out of line with what you typically see from other large utility businesses. Profitability is impressive in comparison to many other utilities. Over the last 5 years, the firm has averaged annual net margin of 15.08% and annual return on equity of 10.66%. This is a pretty straightforward investment. It's primarily a Southern California utility business, which comes with all the good and bad associated with something like that. With economies of scale, a geographic monopoly, and a unique regulatory structure that practically guarantees a profit, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Litigation, competition, and regulation are omnipresent risks in every industry. Utilities don't necessarily have competition in the traditional sense. However, their market's abundant sunshine could lead to customers adopting more power generation at the source, becoming competitors in a sense in the future. More of a regulation in their main market is heightened, arguably to the point of being oppressive and counterproductive. This could be their largest risk. Their main market also has climate concerns, such as regular wildfires, that pose large risks. And California has political risk. A continued push toward greener energy initiatives introduces a near-term growth driver at the cost of long-term uncertainty. Overall, this is a premium utility business with a higher growth rate than a lot of other utilities out there. Yet the valuation doesn't seem to be all that premium. The stock is still well below its pre-pandemic highs of over $160 a share. The stock's price-to-earnings ratio, using the midpoint earnings per share guidance for this year, is 17.4. That's discounted relative to a lot of other quality utility stocks. It's much lower than the broader market's earnings multiple. It's also well off of the stock's own 5-year average price-to-earnings ratio of 36.4. And the stock's yield, as noted earlier, is higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. This dividend growth rate isn't terribly high, but it is higher than what I normally ascribe to utility stocks. That's because Sempra has typically grown faster than a lot of other utility businesses, benefiting from higher rates and more robust profitability. Also, their payout ratio is fairly low by utility standards, leaving them some room for further expansion. I basically split the difference here between their demonstrated 10-year dividend growth rate and the 10-year earnings per share growth rate, which I think is a reasonable compromise. The dividend discount model analysis gives me a fair value of $156.93. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all their future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates SRE as a 3-star stock with a fair value estimate of $132. CFRA rates SRE as a 4-star buy with a 12-month target price of $158. I came out just below where CFRA is at. Averaging the three numbers out gives us a final valuation of $148.98, which would indicate the stock is possibly 10% undervalued. Here's the bottom line, guys. Sempra Energy is a high-quality utility business benefiting from built-in demand for its necessary services, with a market-beating dividend, double-digit dividend growth, a moderate payout ratio, almost 20 straight years of dividend increases, and the potential that shares are 10% undervalued. This is a compelling long-term idea that should be on any dividend growth investor's list. And now for a special news announcement. Williams-Sonoma Inc., stock ticker WSM, just reported a blockbuster Q1 report. Comps were up, get this, 40.4%. compared to the consensus expectation of 23.6%. Earnings per share jumped more than sixfold year over year. We highlighted this stock as an undervalued opportunity late last year when the stock was still below $100 a share. It's now slightly over $171 a share as I speak. And guess what? It's likely headed a lot higher. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.